Well, hello and a very warm welcome to today's webinar. Will Turkey turn around its unsustainable economic policy model? Brought to you by Scope Ratings. My name is Keith Mullin. It's my pleasure to be your moderator today. I'm delighted to be joined by Levon Kameryan, Scope's lead analyst on Turkey, who in a few moments will outline the key factors driving his views on Turkey's economy and economic policy. Levon's comments today follow publication of his research note, Turkey, Current Economic Model, Stores up imbalances, Increased Cost of Disorderly Adjustment in November 2022. This is available on the Scope Ratings website, www.scoperatings.com. After Levon delivered his presentation today, we'll move to a short Q&A session. So please do type in your questions into the questions function on this platform, and we'll do our best to answer them. If for any reason we can't answer them because we need required data, etc., rest assured we will circle back to you one-on-one following the session. So that's it from me. Levon, it's great to see you. The floor is yours.
Thank you very much, Keith. And a warm welcome to the participants of today's webinar on Turkey. Today, I would like to discuss the economic outlook for Turkey in the context of the upcoming presidential and parliamentary elections. Without a doubt, Turkish elections are a highly important event in the emerging market universe, as well as, of course, for us as a rating agency of key relevance for the trajectory of Turkish sovereign credit ratings. So to start, we currently rate Turkey a non-investment grade single B minus for its foreign currency debt and single B for its local currency debt. The one-notch difference between the two rating levels reflects foreign currency liquidity constraints for the Turkish sovereign. The outlook on both foreign currency and local currency ratings is negative because, as the name suggests, because of the unsustainable economic policies of the current government that, in our view, are widening imbalances in the Turkish economy. Why we think that the current economic model is not sustainable. As the chart on the left shows, Turkish companies have been running down their inventory stock pretty strongly since 2021 to meet strong consumption and exports. The negative contribution of inventories to economic growth reached almost 10 percentage points at the end of last year. So this shrinking stock of inventories points to the facts that the aggregate supply in the Turkish economy fails to catch up with increasing aggregate demand, despite the ultra-loose monetary policy stance of the central bank. And instead, as the both charts on the right-hand side show, this discrepancy between supply and demand generates very high inflation within extremely loose monetary conditions. Real rates in Turkey are, as you can see on the chart, some of the lowest in the world. And we do not expect a reset in monetary policy, at least before the next elections, which are scheduled in June. And we recently got the news actually that they might be brought forward for another month. We'll discuss about this later. Our assumption is driven by the fact that any reversal from the current very loose monetary policy would be seen by the public as damaging the credibility of President Erdogan, because he has been advocating keeping interest rates low constantly. So This continuation of monetary policy, at least before the scheduled elections, will keep inflation running very high and lira in a constant pressure mode. Part of the reasoning of Turkey's current economic model was that it would support exports and exporters via cheap credit, weak lira, and eventually close the current account deficit. However, as we see on the charts, mostly due to high energy prices, in parts as a result of the war on Ukraine, Turkish current account deficit has been widening. Turkey is one of the largest energy importers in the Central and Eastern Europe region. And according to our estimates, last year, the cost of Turkish energy imports reached almost 10% of its GDP, or in net terms, so imports minus exports, or around 80 billion US dollars. However, this is only part of the story. As the chart on the right side shows, there has been a significant acceleration in gold imports, non-monetary gold. So this is the gold that is not kept by monetary authorities. In our view, this is the result of weak monetary policy credibility, as this gold is being mostly used as a hedge against high inflation and further currency weaknesses. We also think that this year as well, Turkey will face external imbalances because of the government's loose policies to support domestic demands in the pre-election period, which will eventually drive imports, as well as energy imports in the winter period and lowering tourism revenues. Overall, we project a current account deficit at around 40 billion US dollars for this year, around 4% of GDP. And financing of this current account deficit will be expensive this year due to higher global interest rates. A source of financing, in our view, could be Turkey turning into dollar-denominated Islamic bonds. Turkish reserves remain structurally low despite some improvements recently, as you can see on the chart on the left-hand side. But the central bank has been increasing reliance on domestic banks to borrow foreign currency reserves via swap lines. And if we deduct this borrowing from gross reserves, net reserves are deeply in a negative territory, which is the green line, and they are close to all-time lows. As a result, in order to assess how long the current economic policy model could potentially last, it's important to also assess the ability of Turkish banks to lend hard currency to the central bank. As we can see on the right-hand side, banks and other private sector managed to secure financing in the past, foreign financing, and roll over most of their external debt, even during 2018 lira crisis. So the chart shows the rollover rates of private sector debt for banks and for other private sector. But despite a relatively good track record, we do think that refinancing risks remain high, as Turkey is exposed to changes in investor confidence due to volatile market conditions. We saw the red cycle. For example, at the beginning of COVID-19 crisis, there was a sustained reduction in rollover rates. On top of that, an additional risk is that, as I said, a large share of banks' available foreign currency liquidity is actually parked at the central bank as part of central bank reserves. So in case banks need to repay significant amounts of foreign currency debt or deposits, they would need to somehow access this liquidity in the central bank. But this reliance on domestic banks, on the central bank for foreign currency is a concern in my view, especially if rollover rates of external debt once again fall below 100%. Not only in foreign currency, but also on domestic currency. In lira, Turkish government's reliance on domestic banks has been growing. The central bank has encouraged Turkish banks to buy more government debt in this pre-election period in order to reduce the spending costs to the government. As we can see, yields on Turkish government bonds are currently comparable to that of Poland, Romania, or Hungary, where inflation is much lower. In December, the inflation in Turkey was 64%, while currently 10-year yields are at around 10%. And of course, this is not sustainable. In the meantime, foreign investors have almost fully exited Turkish local government bond markets. The share is actually close to zero now. So this strengthening financial link between sovereign and banking sector is a risk. If after the elections there is a steep rise in interest rates, which is not excluded, especially if opposition wins, domestic banks are likely to experience losses on their securities portfolios. And if not, and the loose monetary policy stance resumes, banks are likely to further increase exposure to the government balance sheet in the absence of foreign investors. This will also raise the possibility of greater vulnerabilities in the medium term. All in all, the government debt in Turkey is still moderate, especially if we compare it to the sovereigns in the region. This is a key strength supporting Turkish sovereign credit ratings. Of course, high inflation helps Turkey because it kind of monetizes debt at the expense of Turkey's creditors. But the government's unconventional economic policies are weakening that trajectory. For example, the government recently announced a new early retirement plan. And if this is implemented, it will have, in our view, a lasting impact, a negative impact on Turkey's debt outlook. The left-hand chart is our baseline scenario, and this scheme is not yet included in the calculations. Another expensive scheme to the budget is the lira deposit scheme, which protects lira deposits from depreciation against hard currencies. And according to official estimates, the cost to the budget last year was close to $5 billion US. And this cost is likely to continue increasing because the scheme has been extended for another year. But the issue is that, in our view, such policies are not sustainable because first they come with a significant cost, but they do not structurally solve the lira depreciation. They also add to the uncertainty regarding the fiscal outlook. And as you can see on the right-hand chart, Turkish debt trajectory is now exposed to adverse scenarios, including such as a significant loss in lira's value or a disorderly adjustment in the economy. And in such cases, Turkish debt would grow steeper with negative implications for borrowing rates. So this is our last slide. And to sum up, Turkey's unconventional economic policy mix has not improved its growth potential, but raised risk to external and public finances. In the baseline scenario, we project economic growth of 3% this year, given substantial policy support and credit stimulus that has been announced in the pre-election period. For the next year, we also project a similar growth rate, around 3%, which, however, is slightly below the average growth rate in Central and Eastern Europe for 2024, but more importantly, also under the growth potential of the Turkish economy, which we estimate at around 4%. However, the longer this credit-driven economic expansion continues, the greater would be the cost of future correction in the economy. So the question is whether this adjustment will take place in an orderly way via economic policies by the government after the elections, or disorderly via market powers. So what economic policies in Turkey will look like after the elections is highly uncertain. First of all, because the outcome of elections is highly uncertain. There are different scenarios for post-election period, and still a lot can change. As I said, even the exact timing of the elections. First scenario is that, as we see on the chart, the opposition wins the parliament while Mr. Erdogan manages to win the presidency. But under the current system, the president could appoint the cabinet without approval from the parliament. So in this case, even with parliament being a position controlled, the current policy of low interest rates and high growth is likely to continue. This was also recently suggested by the Turkish finance minister. In my view, this policy will continue to keep the pressure on lira, and the government will likely have to continue using capital controls and other expensive tools, as it has been doing for the last near past, to ease the pressure, unless the depreciation worsens to a point that the central bank has to raise interest rates and relieve this pressure, as we have seen in the past. A different situation would arise if opposition manages to win the presidency. They are yet to come up with their joint candidate. especially now if the elections are brought forward to May, they will have now even less time for that. Overall, the opposition has already announced its commitments to central bank independence and macroeconomic stability. Of course, this is positive for the price of lira, but if implemented, this is going to entail a significant restructuring of the current economic policy framework in order to address the economic imbalances. This inevitably would entail a significant tightening in monetary conditions via interest rate hikes, and initially this is likely to result in economic slowdown. This is likely to hit the private demand, and as I also said, to put losses on domestic bank securities portfolios. So in any case, reset in economic and monetary policies after the elections is going to be a politically difficult move, but it will be important for the trajectory of Turkish sovereign credit ratings. I will pause here. Thank you very much.
Thank you very much for those comments, Levon. And I'm just getting a message actually that the elections may have been brought forward, referencing your comments to May. So that's not confirmed, but just got a quick message on that basis. But look, there are a couple of questions that have come in, and I've got, in fact, I collected a few as we were going along. So if you don't mind, we'll go straight to the Q&A.
Sure.
And the first one is, what monetary instruments are used by the central bank to control inflation? And how much reserves does the central bank have to cover imports? I don't know if you have those data points to hand, but
no, thank you for the question. Central bank has, as I also discussed during the presentation, has devised several tools to non-interest rate tools, let me put it this way, to control inflation. They discouraged the use of inflation-linked bonds to be used as a collateral with the central bank. This policy is likely to be continued. As I said, the central bank has also encouraged, or if you like, pressed the domestic banks to purchase government debt. Another measure is that there might be some caps on cheap credit. So this is likely to target exporters more than importers or the wider public. But all in all, I do think that in the near term, inflation is likely to stay elevated. First of all, because inflation expectations in Turkey are unanchored. And at least, as I said before the elections, I do not expect any reset in monetary policy.
Okay, so Levon, what is the scope forecast for Turkish inflation this year?
So for this year, we expect some decline from the peaks of November, December last year. Overall, our forecast for the average inflation this year is around 50%.
Okay, very good. There's a question here about foreign investors that I guess demands you to potentially speculate a little bit. But let me ask a question. Turkey has already raised rates only to backtrack and remove people from key positions that go against Erdogan's school of thought. Even if rates rise post-election, will foreign investors take the rate rise seriously?
Mm-hmm. So maybe I can go back a few slides. I think we have this chart here, which which reflects at least relatively long-term trend of foreign investors exiting Turkish local government bond markets. I think the question is whether there is going to be a structural reset in monetary policy, or, as I said, whether central bank will be forced by significant depreciation to hike rates in order to ease the pressure on lira. So which way they go remains to be seen, but I think that the reaction function of investors will depend on the choice of one of these two.
Okay. Very good, thanks. Actually, perhaps we can minimize the presentation so you can perhaps see us a bit more visibly.
Yes.
Levon, I've got some, I guess, what if questions that you don't mind if I ask you. So
Sure.
again, there's I guess, a big if here. And you've kind of touched on it to a point, but so just clarify, is there a chance of a reset in monetary policy if Erdogan wins the elections? And you've kind of touched on it, but can you just perhaps give a direct answer to that question?
So first, I think we need to keep in mind that Erdogan has been advocating for low interest rates, and any interest rate hike needs to be weighed against the fact that this might potentially damage the credibility of this approach. So it's more likely than not that the current policy of low interest rates will be resumed, as I said, unless there will be a need beyond the current relatively expensive policies, expensive to the budget, to also act on the interest rates.
Yeah, absolutely. Now, in your final slide, you talked a bit about some of the potential election outcomes. And here's a question which is relates to that. What's the main challenge as pertains to economic policy for the opposition if it wins the elections?
So, in my opinion, doing economic policy rebalancing will be the main challenge of the opposition. But this is easier said than done. As I explained, a steep rise in interest rates will be necessary to structurally solve the problems related to high inflation and lira pressures. In my opinion, this could also enable Turkey to rebuild foreign currency reserves, but this entails putting brakes on cheap money to the private sector and to the economy, which will initially slow the domestic economy, and also with associated losses on domestic banks. So this will be a politically challenging move to do.
Yeah. So now, if again another if question, if Erdogan resumes the presidency, will the opposition remain united in parliament?
So given the fact that under the current rules, at least the president can govern the country without too much oversight from the parliament, I think this will be a pressure for these 6 opposition parties to stay united on all issues. Of course, another factor to be considered in terms of in terms of parliamentary functionality is the outcome for the pro-Kurdish party, which might play an important role if parliament is hung, if of course they are not eventually banned from elections altogether.
Indeed. Now, we haven't talked much yet about external developments per se, but to what extent will external developments affect the outcome of the elections? I mean, it's an overarching sort of broad question, but perhaps you can have a stab at some thoughts.
Yeah. No, that's an interesting question. And external developments indeed will have an impact on elections outcome. What's important is that Turkey has shown ability to balance the relations between the current contexts between the West and the East. So, and also the geopolitical importance for both West and East has increased. So I think this could play in the hand of the current government. And we do also see it in the current context. There seems to be discussions of US President Biden asking, for example, Congress to approve the sale of these F-16 jets to Turkey. And at the same time, Turkey is also managing to expand its economic cooperation with Russia. So I think these are relevant also to the outcome of the elections, as far as I'm concerned.
Yeah, indeed. I've just got a three-word statement here, which is a symposium in itself, but I'll just put it to you. It's this: Russia-Turkey relations.
Yeah. So at least looking at the numbers, the economic cooperation between Russia and Turkey has increased since the intensification of the war on Ukraine. Turkey now accounts for almost, if I remember correctly, around a third of Russia's non-energy exports. And this figure was around 10-15% in the pre-war period. And of course, there are short-term gains for both countries. They seem to agree on different projects. But one thing to keep in mind is that trade balance between Russia and Turkey is negative. So in the tune of 15 billion US dollars last year was the difference between the trade between Russia and Turkey. So this means that if Turkey starts settling in rubles for trade with Russia, which is already happening for some of the energy trade, Turkey might need to spend hard currency to buy Russian rubles. So this might, as we go, put a strain on Turkey's already depleted foreign currency reserves. But of course, these assumptions are subject to the agreements of currency settlement between the two.
Yeah, absolutely. So look, I have one more question on my list, but before I ask it, if anyone viewing the session has any final questions, please do type them in, because we'll be finishing the session once Levon's answered this final question, which I think will be quite a short one. So yeah, just a couple of minutes left if you have an urgent burning question. Levon, the question I have now, I think you've touched on it. You talked about the growth forecasts for Turkey this year. What's the medium-term growth potential of the Turkish economy?
Yes, so we estimate the growth potential of the Turkish economy at around 4% annually in the medium term. This projection assumes rather conventional economic policies and relative macroeconomic stability. As you rightly mentioned, over the next 2 years, our projection of economic growth in Turkey is under potential around 3%.
Okay, sounds good. Well, I have no more questions on my list, and there are no more currently appearing in the questions bar here. So I suggest, Levon, that we close the session. So thank you so much for your insightful questions, and thanks for having a go at the what if questions as well. Thank you for watching. Hope you found that of interest. After this call, we will be reaching out to everyone who registered with a replay link, because I'm sure there are things that you will want to watch again that you may have missed in today's session. And we'll also provide a link to the research note that I mentioned earlier on today. So that's it from us. Thanks for your attention. We will obviously, we're watching events very closely, and depending on those outcomes, we will come back perhaps later in the year with an update. So that's it from us. Have a very successful rest of the afternoon, and it's goodbye from us. Thank you very much.
Thank you.